at the right time.
Good morning, you're watching All You Need to Know on Bloomberg Quint Live and I'm Alex Matthew. First, the headlines. Finance Minister Nirmala Sitharaman will present the first union budget of the second term of the Narendra Modi government today. The speech begins at 11 a.m. The government has ordered a serious fraud investigation office probe into the functioning of Jet Airways after finding instances of fund diversion and large-scale irregularities. Oil prices fell despite a continued drop in U.S. inventories as demand fears continued to outweigh geopolitical tensions with Iran. And Asian markets are off to a muted start in the absence of directional cues. Focus has shifted to key macro data to be reported tonight in the U.S. Now, India's economic survey has outlined key focus areas that will ensure that India becomes a $5 trillion economy. The survey, authored by Chief Economic Advisor Krishnamurthy Subramanian, also lays down the roadmap for India to achieve a growth rate of 8% in order to hit that target. Are these targets achievable, though? Ira Duggal caught up with Renu Kohli, who is an independent economist, and Kaushik Das of Deutsche Bank. Here's a slice of that conversation.
Kaushik, I'll start with you on the more immediate projections and aspects of the economy that the survey flags off. One is that, the growth numbers will look like about 7% in the coming year, which seems like a reasonable expectation. And then once again, the reiteration that should we aspire to go towards 8%, then investment has to be sort of the key part that you have to focus on.
Yeah, so, the 7% growth estimate for FY20 is what we have as well. And I think RBI is also projecting 7%. But obviously, there are headline risks to this growth estimate because monsoon is uncertain. We've had, 28% below normal monsoon rains as of now. And if monsoon rains end up being lower by September, then you could end up with maybe 20-30 basis points lower than where we are. So growth could fall to 6.7, 6.8, just like previous year. And then we have this problem of this NBFC sector, not kind of coming up to speed. And that could also lead to, slower growth recovery in the second half that we expect. So 6.8 to 7% is something reasonable for this year. And given the global backdrop, I think, 6.87 India would look pretty good and will continue to get capital from, other countries. As far as the longer term story is concerned, we have done a study and 2 weeks back we published a report about this $5 trillion economy. And what I found was that if you have 7.1 to 7.3% growth sustained over the next 5-6 years on a real GDP growth basis, and you end up having 11.5% nominal GDP growth, which is pretty reasonable. And if rupee is stable within 71 to 72, that kind of a range between 70 to 72, you should be able to achieve $5 trillion, kind of economy by 2024-25. Now, as far as the growth model is concerned, I am fully in support of this savings investment-led growth model rather than, having a credit-induced model. So to that extent, you would expect fiscal consolidation to continue, so the savings pool increases in the economy. And you should expect also RBI to have a prudent monetary policy stance so that you have adequate savings in the economy. I think it's achievable, but 8% to me looks like a long shot given the global backdrop. 7.5 should be achievable in the next 5 to 6 years.
Ma'am, let me come to you as someone who has seen the economy from the inside and from the outside and continue to observe it. It's interesting that, almost year after year, we talk about the need to push up investment. We had a period where we had strong investment to GDP ratios that fell off, and we still continue to aspire to get back to those levels. But one doesn't glean any clear policy or any sort of, policy shift that would move us in that direction very quickly.
The big picture is saving investment, exports, etc. is completely fine.
and agreeable, and I completely endorse that. Now, the subsequent chapters you would expect would outline that path. I found that they're a bit of, sort of scattered apart, because while the economic survey does argue very strongly in favor of exports, it doesn't quite spell out in the subsequent chapters as to how to get there and what's going to be the pathway. Except to a certain extent, even the chapter on MSMEs, the dwarfs and how they need to grow up, and which is itself, completely laudable objective in itself. It links the MSME more to employment elasticities, their job creating potential, and what ought to be done. That is not directly linked to exports. It mentions labor reforms and mentions Rajasthan's case in that context, but doesn't again link it to exports and whether there's going to be some kind of a state effort to direct in domestic or foreign investors into those sectors and join it to exports next. Second is, I also found that I think that the global scenario, while comparing with China and China's and the East Asian miracle, is completely fine. I think all this happened about 40 years ago, 30, 20, and even China's now more than a decade has passed before we talk about China's export-led investment model. It does touch upon the global environment and says it is a bit difficult at this point, but I do think that we need to recognize that the global environment, there appears to be a structural change. Post-crisis growth, global growth has not come back to, continues to be below trend, and particularly in the advanced economies, there is increasing convergence towards the viewpoint that there is a case of secular stagnation, because whatever the drivers of long-term growth are, including demographics and so on, they're all on the downtrend.
All right, those are the takeaways of the economic survey, the coverage of which you will find on the website. For now, let's go on and talk about the budget. What are the market experts expecting from Finance Minister Nirmala Sitharaman's maiden budget today? We caught up with some big market names this week. Here's what they had to say.
They can lower interest rates further. And you look globally, interest rates are headed down almost everywhere. In Europe, it's a negative rate. It's just insane what's happening. But the reality is it's very good for India. The other thing is I believe that the Indian government could afford a greater deficit. I believe 3.5, I think it is now, against GDP could go up. And they have a lot of room. I believe they could go to 5.
The budget is somewhat less relevant. It's really more about the policy impetus that the new government has, and there are two things that they need to do. First, in the near term, finding a way of solving this liquidity crunch that is going through in India is absolutely critical. Effectively, if they don't do anything on this front, the likelihood that growth falls off even further, I think, increases meaningfully. And this is something that they can address pretty easily if they want to. And the second thing, of course, is from a longer term perspective, the structural reforms that need to be unfolded for the India to get to its manifest destiny, recognizing that there's no natural way to get there. They have to actually do a whole lot of hard work in terms of facilitating capital deployment.
We're expecting some initiatives, be it on infrastructure, being it on aiding rural distress, etc., that can certainly help. But also, I think the central bank has a significant part to play, and it's begun that part by cutting rates. I guess the issue has been not only election uncertainty, which is now out of the way, but clearly, to our mind, the cost of capital has been still too high. Real interest rates have been too high. And obviously, the ongoing issues around certain NBFCs and the liquidity squeeze that we're seeing in certain pockets of the financial system are clearly still hurting. So those are the sort of key priorities that need addressing.
All right, leading economists also spoke about the key areas that the finance minister should focus on in the budget. Listen in.
There is a responsibility that the Ministry of Finance has over capital markets and over financial services. That responsibility over financial services and capital markets is an ongoing thing. It has very little to do with the budget. So I'm not going to focus so much on the financial sector as well and the capital markets. That is something that we can talk about later, separate from the budget, because the budget really doesn't have very much to do with that. And again, there are many things that they need to do over there that they should be doing. But on the budget per se, which is, what should the tax and expenditure of the country look like, I think they need to come up not just throwing things again to try and lift the growth rate for 6 months or 9 months, and it never really works because as we've seen in the past, but actually start thinking about, given the mandate that they have, that over the next 5 years' time, what do I want to do? What do I want to see India's budget look like 5 years down the road? Where do I want my tax structure to look like? And more importantly, where do I want my expenditure what should my expenditure look like? There are questions about whether or not India's structure of spending, what we do on capital account, what we do on capital spending, what we do on current spending, that may actually not be the right one if India is actually going to look for and encourage new sources of growth and not depend on the generosity of strangers, basically, external trade to get it through. So I really think that, or I really hope that the government actually sits down and says, look, we have a 5-year mandate. We are going to look at this as a 5-year project, and here is what we are going to do, rather than say, look, I'm just targeting what's going to happen by March 2020.
The dilemma is, when growth is slowing and monetary is not effective, shouldn't fiscal be easing? Right? That's the theoretical argument. Fiscal policy should be counter-cyclical. But the reality is, if at this point we agree, you get a 0.5% of GDP stimulus, that will just be counterproductive because all rates will go up in the system. Right? But there's a way out, and the way out is, this is the year the government should double down on asset sales. Last year they sold about 0.5% of GDP. Let's hypothetically say they double that to 1% of GDP. Then you can do two things at the same time. You can keep to your fiscal deficit of 3.4% like last year, and the bond market will be comforted. At the same time, because you're generating more revenues through asset sales, not through taxes or duties, your fiscal impulse is actually positive. So you get the best of all worlds. You're imparting a positive 0.5% of GDP fiscal impulse to the economy. Fiscal policy is actually being counter-cyclical without the deficit widening. Right? And I think this is the year where those kinds of solutions, which are now possible with such a large majority, need to be entertained.
No, so finally something to agree on.
You agree on the fiscal part, I know that.
Yeah, so the disinvestment side, I think, is a given. I think not just privatization, but also asset sales. We have at least some recognition that there is a requirement of fiscal discipline. So across party lines, whatever may have been Nyaya, etc., there is some recognition that if you slip up on fisc, it creates problems on the external accounts, and then it kills the currency and creates more problems. I think across party lines, people have understood that. Therefore, some discipline. So in this environment, can we open up the capital account a bit more? Capital inflows as percentage of GDP are down to 2002 levels, right? Can we change that? Because we get more capital, we can grow faster. So I think from a financial system perspective, there is enough that you can prescribe in terms of a holistic approach to intermediation, to increase of foreign capital inflows, get the financial system working.
I certainly would not like to see more of an increase in MSP and the traditional fertilizer subsidies, more loan waivers, those kind of things. Not that loan waivers are bad. I think we need to move away from that towards a total comprehensive program, rather than doubling down on doing the same bad things that we were doing. I think we don't need to do that.
All right, Nomura's Sonal Verma says that expectations from the budget need to be tempered. Speaking to Bloomberg Television earlier today, Verma said that the government can choose other revenue-generating modes, like asset monetization, in order to maintain its fiscal position. Listen in.
the big picture vision of this government for the next 5 years? That's something we'll be watching very closely. And second, yes, this budget comes in the backdrop of weak economic growth. So how exactly is the government planning to boost growth? But as you know, there isn't much fiscal space, so it's going to be a tight balancing act for the budget. I think we should keep expectations from the budget low. This is not the only platform for the government to announce reforms and growth-enhancing measures. So expectations should be fairly low, also because the fiscal side is quite constrained.
Yeah, as you mentioned, growth hasn't really been great in India. This GTV chart showing that it's slowed to a 5-year low of 5.8%. How does this bode when we have seen this complication where tax revenues this year have been a little bit disappointing?
So since the budget was presented in February, both direct taxes as well as indirect tax revenues have disappointed. So the fiscal deficit target that was presented back in February looks difficult to attain, which is 3.4%. But I think the government has actually postponed the fiscal consolidation plan for quite many times, I think, in fact, for the last 3-4 years now. So it is quite important from a signaling perspective to essentially, show that they are intent on consolidating on its fiscal finances. Now, as far as growth is concerned, how do you boost growth given the fiscal constraints? I think the one strategy that the government can use is focus more on asset monetization as a measure to get more revenues. And second, send the right signals in terms of economic reforms, measures to improve the business climate, direct tax reforms, so bringing down tax rates, but also removing some of the exemptions. So I think, these are 3-4 things that can be done without straining the fiscal purse.
Sonal, in terms of the deficit that you mentioned, we do have a chart here on the Bloomberg that illustrates that. And you can see that, while the deficit is forecast to rise, it's still in a much better position than it was, say, 5 years ago. Now, you also referenced there, or we saw on a chart a moment ago, the potential of asset sales to offset some of this. What do you think would be being looked at in terms of asset sales, and to what value?
Well, Paul, this number has already been presented back in February, and at that point in time, the government had set a target of close to 0.4% of GDP, which is actually quite aggressive, but something that we do think that the government can achieve. I think it's not just about the target that they set for disinvestment. The government and government in the sense of broader government, including the public sector companies, do have a lot of land banks as well that can be monetized. The government, can auction oil and gas fields. It has, telecom spectrum auctions, and there are many other assets that the government has. So beyond the sort of disinvestment plan that they set in this particular budget, we need to understand that the infrastructure requirements of India are quite large, and if India is going to or needs to take advantage of the supply chain disruption, it needs to put in place public infrastructure spending. So asset monetization in a more broader sense, not just disinvesting particular stakes, is a strategy that needs a big push to be able to sustain public infrastructure spending. So what we would like to see is really the big picture vision rather than sort of specific numbers in this particular budget.
We've talked about the deficit. Let's talk a little bit about debt, because Bloomberg News was running a story that there's some concern that debt's being masked to an extent by state-owned firms and using special bonds. Do you think the market has a clear picture of just how big India's debt is?
So, if you look at the center state debt, and plus, of course, now there's talk of debt of some of the public sector companies, the number could be between 65 to 70% of GDP. I think the bigger concern has been the flow rather than the stock. So the incremental borrowing of the center government, the state governments, and the public sector companies, which together perhaps are close to 7.5 to 8% of of GDP. And of course, this has come at a time where savings are already quite low. So the concern is that the government is sort of crowding out private sector. Although, to be fair, private sector investment demand is quite low right now. So I'm not really sure this is really crowding out. But what definitely is required is to have more transparency around where the aggregate fiscal stance suggests. Ideally, if the government gives that clarity today, that's great. But I again would not put too high hopes in terms of transparency of some of these off-balance sheet items.
All right, the focus in the market clearly, undoubtedly, on Budget 2019, and that will start in just a bit. Agam Vakil is here to tell you what to expect at the start of trade and what's happening in the futures and options space. Agam, probably a very tough job to do because we're all trying to understand what the finance minister will put forward.
Yes,
but how are we looking at the start of the day?
Right. So, Alex, we've spoken about this. Considering a lot of that which may come through the budget will largely been factored in. So we're looking for small, perhaps some announcements, and that could possibly move the budget, or pardon me, the markets. But for now, what has been typical, very little movement on the SGX Nifty, and eventually we may very well see a move coming through. But there are a few factors that I will address a little later on that will actually show why and how the markets have factored in a lot of perhaps small announcements. For now, at least as far as the Nifty is concerned, we did see a 0.25% increase there. 4 straight days of gains. That, of course, is a positive, though on low volumes. And the mid-cap and the small-cap indices were showing mixed movements. Coming down to your banking indices, again, we do have strength in the PSU banking index, and I suspect this is largely to do with some more capital provision for these PSU companies. Again, it's a wait and watch. It's speculation. We don't know anything for certain yet. Let's move on and talk about the other factors. So as far as your fund flows are concerned, we've literally seen nothing. About 29 odd crores worth of selling coming in from FII stable, 58 crores coming in on net basis in DIIs. It's largely been cancelled out as far as inflows and outflows is concerned from both institutional segments. Of course, as far as your indices are concerned, it was a very quiet day of trade, I'd say, except for futures and options, of course. But we really don't have something like a Kotak Mahindra Bank or UPL advancing, and that being cancelled out by Titan Company, HDFC Bank, and Tata Steel. Moving on, let's also talk about futures and options, and this is where we are starting to get clues. Firstly, traders are not, taking new positions. Secondly, they're also unwinding some, but the unwinding is also not great, as is indicative in the Nifty futures. The Nifty banking futures here, again, we are looking at about 6.8% increase in open interest, but mind you, this is on account of anticipation in what we can have when it comes to the public sector space, which is why we are seeing an increase in open interest for the Nifty banking futures. Let's move on and talk about your open interest distribution, and this is fairly indicative that we're not really expecting too much coming through, at least as far as traders go. They aren't, considering it's still a 500-point range, and on the higher end, the max OI is around 12,500. This tells us very little. In fact, this tells us there is likelihood of consolidation in the long term, and we're not expecting the Nifty to move beyond 12,200, 12,300. Of course, we saw writing yesterday around the 11,900 put. Sure, that was again on expected lines. But moving on, this is perhaps the most critical factor which indicates that traders out there are not really factoring in anything. Week in, week out, at least as far as the last 1 or 2 weeks are concerned, a lot of analysts are selling strangles, and that is evident in your WIX, which is declining by as much as 1.2%, and it's actually come off from levels of 16. And it seldom does it happen that you actually see the WIX come down ahead of the budget. Well, this, you can draw your own conclusions from this one. And of course, your put call ratio, of course, edged up higher at around 1.5. We don't have too much movement there. We do have Diwan Housing Finance, Reliance Capital in the F&O band, the usual suspects. And besides that, we're watching out for something like a Piramal Enterprises or Maharaja Batteries or Bank of India in terms of stocks which did see an open interest increase. Unwinding, well, we may not have too much except for something like a just dial. Keep an eye on this one because we certainly have seen a lot of strength there. This is a bout of, well, longs unwinding, and Bank of Baroda, of course, from the public sector space, because that is one key area, one key sector that we are going to watch out for. So, Alex, it's going to be about realty, public sector space, and perhaps something to do with agricultural stocks today. Those will be in focus. Besides that, we're not expecting too much in the Nifty, at least until we have the presentation of the union budget.
Absolutely. Thanks so much for that, Agam. All right, on to some corporate news, and it was good news from ArcelorMittal as the National Company Law Appellate Tribunal approved their 42,000 crore rupee resolution plan. However, it was not good news for the Committee of Creditors for Essar Steel. Why is that? Well, Paspati Upadhyay has the answer.
Well, the NCLAT order brings good news for ArcelorMittal, but not so much for Essar Steel's Creditors Committee and, well, creditor committees in general, which usually consist of financial creditors. And I'll come to why in just a bit, because besides deciding on the eligibility of ArcelorMittal's plan, the NCLAT had to also determine in this case the allocation of funds between financial and operational creditors of Essar Steel. The NCLAT concluded that the allocation approved by Essar Steel Creditors Committee was unfair and discriminatory. The NCLAT has gone a step further to say that Creditors Committee have no role to play in the distribution or allocation of funds to various creditors. The allocation the NCLAT has held can only be suggested by resolution applicants, and if this allocation is found to be discriminatory, it's open to judicial review. The NCLAT hasn't stopped here. It has also more importantly held that there is no distinction between different kinds of financial creditors. When I say different kinds of financial creditors, I mean secured and unsecured financial creditors. And lastly, the NCLAT has said that there is no distinction even between financial and operational creditors of a corporate debtor at the resolution plan stage. Now, let me point out the IBC lays down a waterfall or a hierarchy under Section 53, based on which allocations or priority is given to different kinds of creditors, whether it's secured, unsecured, workmen, employees of the corporate debtor. The NCLAT has said that this waterfall needs to be applied to the liquidation stage, and there is no reason why any distinction needs to be drawn between different kinds of creditors at the resolution plan stage. In terms of implications, experts say that this has turned the credit hierarchy as they understood it so far under IBC on its head. It will remove the distinction between, let's say, a creditor which has been wise enough to lend only to the extent of its security versus a creditor who has just lent to a stressed asset or a corporate debtor without taking due cover in terms of security. The second important implication of this is that if a secured creditor has to realize that at the resolution plan stage, it's going to be treated on a par with an operational creditor or an unsecured financial creditor, experts fear that they might start rejecting resolution plans because they'll realize that at the liquidation stage, they can that distinction will come alive, and they can very well use that security to maybe perhaps get a better claim. Now, all of this will be further clarified by the Supreme Court because Essar Steel's Creditors Committee has decided to appeal it in the coming days.
All right, we'll stick with that story and bring you updates as and when we get them. For now, let's turn to Mishika Parak, who's joining us now to tell you all about the stocks in news. Good morning, Mishika. What's on your list today?
Good morning, Alex. So the results season has started, and the first one we're looking at is GM Breweries, which posted weak numbers. The net profits are down 27% at 16 crores, EBITDA is down 24% at 26 crores, and margins stand at 22% versus 31% last year. Now, the weak results are on the back of higher raw material cost. Raw materials as a percentage of sales stand at 69% versus 60% last year. Then we have an operational operational update on Sobha for Q1. The company sold more residential units in the first quarter, even as the average price realizations declined. The sales volumes of its residential units have jumped 11% in the quarter, from 0.96 million square feet to 1.06 million square feet on a yearly basis. And average price realization fell by 8% to 7,312 rupees per square feet. A change in sales mix across various projects impacted realizations. Then we have Diwan Housing Finance. They have defaulted on interest payment of non-convertible debentures worth 4.8 crore rupees. The company is already in the process of selling down its loan assets, including wholesale project loans, to make good all its obligations. Yes Bank has acquired over 9% shares of Eveready Industries by invoking pledged shares following a loan default by McClure Russell. Pfizer has received Maharashtra MIDC approval for business transfer to Vidhi Research and Development for a consideration of 178 crore rupees. And last on the list is Maruti Suzuki. CCI ordered a probe on the company after a dealer complaint. Now, as per a CCI press release, the probe is on alleged anti-competitive conduct in implementing discount control policy on dealers.
Thanks so much for that, Mishika. All right, several stories available on the website, bloombergquint.com, particularly on the economic survey that was released yesterday. But let me take you through a couple of others. The government has ordered a Serious Fraud Investigation Office probe into the affairs of Jet Airways after finding instances of fund diversion and large-scale irregularities. The government will also oppose Naresh Goel's plea in the Delhi High Court seeking a lifting of the travel ban. The International Court of Justice will pronounce judgment on the Kulbhushan Jadhav case on the 17th of July. According to the International Court's website, Jadhav, remember, is on a death row in Pakistan. The sentence will be pronounced by the court's president, Judge Abdul Qawi Ahmad Yusuf, according to the website. That's all you need to know going into trade today, and indeed ahead of the budget 2019. Do stay tuned. All of the coverage is just up ahead. This is Bloomberg Quint.